Hello, my name is Carrie Lentz, and I'm the District Vice President for Edmonton East at TD Canada Trust. TD is very proud to sponsor Eric's New Women's chapter of the Career Mentorship Program. This program will feature a series of modules designed with women in mind for professional growth and personal wellness. Please check back each month for new and exciting installments. Enjoy.
My name is Monica Singh. I'm a branch manager with TD Canada Trust. A little bit about my background. I came to Canada 10 years ago, exactly about 10 years ago, as a student to complete last 3 semesters of my BBA degree. So the institution I was studying at in India, they had some kind of a tie-up with Thompson Rivers University in Kamloops. So I came here, majored in finance, and while doing my semesters, I also had the opportunity of doing a co-op work term with my own university. So co-op work term is more like a paid internship. It's actually really cool. If you get a chance, totally do it. And so that really was the very first exposure I had to Canadian work culture. Now, I moved here in my teens, but even if you're moving later, it's a very adaptive work culture, so nothing to worry about. You'll become a part of it very easily. So a checking account, as the name suggests, it's very current, so basically managing your daily cash flow. So very transactional in nature. So for instance, you can use a checking account to receive your paycheck, to pay a bill, or to buy a coffee if you don't use a credit card. So very transactional, very cash flow related, if you will. Whereas a savings account, as the name suggests, is basically made to save money. Now, I will say this right off the bat. If you're looking to save money long term, do not be saving it in a savings account. The interest rates are not awesome. It's a good account to kind of tuck your money away. So let's say you make $1,000 in income every month, and you're saving $50 off of it. It's a good account to kind of keep it, short term, but not something where, I'll basically try and invest my money because it's literally just sitting there with very little interest. What's also important is you understand the terms and conditions that come with these accounts. So what are the fees? What can I do to waive it off and stuff like that? So when you're going into a financial institution, make sure you talk about these and know these well, because it's very important. Budgeting is key. The most basic thing that you can do with your finances is budgeting. It could be a simple spreadsheet, honestly, where you're literally writing down what your income is, what are your expenses, and how much you're saving or stuff like that. Or most of the financial institutions in Canada, they'll have some kind of an application, some kind of a thing where you can go in and it'll monitor your activity. So for instance, TD customers, you have TD MySpend app that keeps a very good tab on what your expenses are. If you're going above in a particular category, it'll let you know. So really important to do that. What's also important is start saving money early. So there's something called time value of money that we say very often in our banking jargons. What that is saving $50 a month. So my earlier example, if you are making $1,000 a month, even saving $50 a month going forward, starting today, can make a lot of difference to the actual amount that you have saved, plus the growth, right? So depending on what you're investing that $50 in, it could, very well add another, few $100s to the year. And that's important. The time value of money is important. What's also, something that we should keep in mind is saving for emergency funds. So now more than ever, with COVID hitting us, Canadian government, they recommend saving 3 to 6 months of your expenses in an account where, if something like this happens, you're kind of looked after. And let's say you're not able to make the same income, you're still able to live your life until those, in the 3 months, then you can figure out what to do with next. But just kind of have, something like a cushion, like an emergency fund to go. You want to have a credit card. You want to start with a credit card. And the reason is most of us are not able to pay for a car or a house or any big purchase through cash. We would need access to, some kind of a money, lending, basically borrowing money to make those purchases. So what happens in Canada is we have something called Credit Bureau Report, which kind of records, all the debt that you've had during your lifetime. So, starting from a cell phone bill to, mortgages, all of that is reported on the Credit Bureau. So you want to start that, because unless you have a history, it's very tough for a bank or a financial institution to make a decision on if they are going to help you buy a car or a house. So you want to start with that. What's more important to know is you want to pay it off in time. So having a credit card, start there, use it and pay it off in time. Another thing that, most of the people are not aware of is called utilization. So what utilization means is, let's say I have a credit card and the limit on that is $1,000. I don't want to use 900 off of it every month or 1,000 off of it every month and pay it off. You want your utilization to be around 30 to 40% of the limit. So on $1,000, you don't want to go above, 400 most of the times. If you have to once in a while, it's okay. But you want to keep your utilizations really, really low. That'll help your credit bureau. Now, the other good thing is most of the financial institutions in Canada, they have really cool, nice programs for new immigrants. So for instance, TD, we have 6 months free banking, unlimited transactions, and also $1,000 credit card that you get right off the bat to start building your credit. Because like I said, it's very important to work on that. And so, most of the financial institutions would have something of that sort to get you going. Two important things here. So know your statement date. So, in a month, 1st to 30th or 31st, let's say your statement date is the 20th. So what that means is purchases from 20th of last month to 20th of this month would be on that statement. And that statement will tell you how much you need to pay by what date. Make sure you follow it to the letter of the law. You have to pay that amount by that particular date. I always recommend, if you, let's say you have your bank account with one institution and your credit card with another, make sure you pay it even a week in advance. That way it gets in time. So, when I was talking about making sure it's paid in time, that's important. So keep an eye for your statement date. Once your statement is released, see what the date is you have to pay it by, see the amount, make sure it's paid. Or you can set up automatic transfers where this will happen automatically. It will go out of your account. You don't even have to worry about it. But if you want to keep a good, kind of line of sight and want to do it yourself, you can do it as well. Just make sure you have a good process figured out.